Welcome to this special deep dive brought to you by Finbot Insights. Today, we're really digging into the bedrock of modern investment thinking.
That's right. A framework that fundamentally changed how we approach growing wealth while, keeping a careful eye on risk.
And it's a challenge every single investor faces, isn't it?
Yeah.
From the big institutional players right down to you, our diligent retail income investor.
Absolutely. How do you aim for the best possible returns without exposing your hard-earned capital to risks you don't need to take? It's a constant balancing act.
A very delicate and intricate dance, you could say.
It truly is. And this inherent tension, this constant push and pull between wanting more returns and being cautious, that's precisely what spurred Harry Markowitz back in 1952.
Yes, his groundbreaking paper, Portfolio Selection.
Exactly. It laid the foundation for what we now universally call modern portfolio theory, or MPT. And, it was nothing short of revolutionary for finance back then.
It provided a quantitative, a systematic blueprint for tackling this age-old investment challenge. So profound, it earned him a Nobel Prize later on.
It did indeed. And at its core, MPT introduces this, well, it seems simple now, but it was a totally transformative idea.
Which is?
That by thoughtfully selecting a diverse mix of assets, you, the investor, can actually optimize your portfolio. You can aim for the best possible returns for a level of risk you're comfortable with.
Or, looking at it the other way, minimize the risk for a return target you have in mind.
Precisely. And this shifted the focus completely. It wasn't just about picking individual winning stocks anymore. The focus moved to understanding and optimizing the entire portfolio as one cohesive unit.
A real paradigm shift.
Absolutely. So our mission in this deep dive is to guide you through this whole intellectual journey. We'll start by dissecting the core principles, the foundational pillars of MPT.
Okay.
Then we'll pivot to the real world. We'll look at the practical challenges the criticisms MPT has faced because, let's face it, theory doesn't always translate perfectly.
That's important to cover.
Definitely. And finally, perhaps most importantly for you listening, we'll highlight the cutting-edge advancements and, the emerging trends that continue to refine MPT's usefulness today.
Helping retail income investors navigate these complex financial landscapes with, hopefully, more confidence and precision.
That's the goal.
And this whole exploration, it draws from quite a robust set of sources, doesn't it?
Yes, we've looked at critical reviews of MPT's limitations, practical guides on how it's actually applied, and of course, Markowitz's original seminal paper.
Plus, a big review covering 60 years of portfolio optimization research.
That's right, a lot to unpack.
Okay, so let's dive in. Let's start with those foundational pillars. Where does Markowitz begin?
Well, Markowitz's 1952 paper, Portfolio Selection, it essentially provided a quantitative lens that just wasn't common before. Think about how decisions were made pre-1952.
Right, a lot of gut feel, maybe looking at companies in isolation.
Exactly. It was often a mix of intuition, industry trends, maybe some basic fundamental analysis, but the concepts of return and risk for securities were handled, let's say, quite informally, ad hoc, really.
So what did Markowitz do?
He meticulously quantified these previously qualitative concepts. He introduced statistical measures, expected return, that's your potential gain, and standard deviation, that's the measure of risk, basically the volatility or the fluctuation around that expected return.
So giving investors actual numbers to work with for risk and return.
Precisely. It allowed for a much more, data-driven understanding of an asset's characteristics on its own.
That sounds revolutionary in itself, doesn't it? But he didn't stop there.
No, he then suggested something really innovative, maybe even counterintuitive for the time. He argued investors must consider both return and risk together, conjointly, as inseparable parts of the decision.
So you can't just chase returns, and you can't just hide from risk. It's about the trade-off.
Exactly. Your allocation decisions, he argued, had to be based on your preferred trade-off between those two factors. And this moved the focus beyond just the value of single investments.
It shifted the paradigm towards understanding not just individual assets, but critically how those assets interact within the bigger picture, the portfolio.
And the revolutionary nature of this quantitative trade-off, it really boils down to two key reasons. They're worth pausing on.
Okay.
First, it enabled this joint quantitative evaluation of the portfolio's return and risk. And it did this by considering not just the individual returns, but crucially, their co-movement.
How they move in relation to each other. Like, do they go up and down together?
Precisely. Or does one tend to go up when the other goes down? That concept, Correlation was a revelation in this context.
And the second reason?
Second, and equally profound, Markowitz formally framed financial decision-making as an optimization problem. This wasn't just a nice idea, it was a solvable mathematical challenge.
Ah, so turning investment strategy from qualitative guesswork into something rigorous, data-driven, that you could actually solve mathematically to find the best options.
Exactly. Finding the most efficient portfolios.
Which brings us neatly to the power of diversification. It's a concept most investors hear about, but MPT gives it real quantitative backing.
It really does. The fundamental principle here, and it's critical, is that a portfolio's overall riskiness doesn't just depend on the average risk of the things in it. It fundamentally depends on the correlations between those assets.
Right. It's not just about having lots of different things, but having things that behave differently from each other.
Perfectly put. If all your assets go down together when the market hiccups, you're not really diversified in the way MPT envisions. This focus on correlation was a major departure from older ideas that just focused on finding undervalued single assets.
And MPT makes a very useful distinction between two types of risk, doesn't it?
Yes, absolutely crucial for you to grasp. First, there's systematic risk. You often hear this called market risk. This is the risk inherent to the entire market, or at least a big chunk of it. Think broad economic downturns, unexpected interest rate hikes, major geopolitical events, things that affect almost everything.
And the key point about systematic risk.
The key point is you cannot eliminate it just by diversifying your portfolio, because it affects practically all assets to some degree. It's like the tide, it lifts or lowers all boats, more or less.
Okay, so that's systematic risk. What's the other type?
The second type is unsystematic risk. This is also called diversifiable risk, or sometimes specific risk.
Ah, so this is the one we can do something about.
Exactly. This risk is specific to an individual company or maybe a particular sector. Think of a product recall hitting one car maker or a new regulation affecting only, say, biotech firms.
Or a management scandal at a single company.
Precisely. These are examples of unsystematic risk. And Markowitz's profound insight was that this type of risk can be significantly reduced, maybe even practically eliminated, through proper diversification.
By not putting all your eggs in one company's or one sector's basket.
That's the essence of it. Let's illustrate the benefit. Imagine combining assets with low, or better yet, negative correlations.
Like the classic stocks and bonds example.
That's the textbook case, yes.
Yeah.
Historically, when stock markets wobble or decline, high-quality bond prices often tend to rise as investors seek safety.
So the gains in bonds can potentially offset, or at least cushion, the losses in stocks.
Exactly. That dynamic helps to smooth out your portfolio's overall performance over time. It reduces volatility, making for a less bumpy ride towards your financial goals. Very important for income investors seeking stability.
And diversification isn't just about stocks and bonds, right? There are other ways to spread risk.
Oh, absolutely. You can diversify across various asset classes, equities, fixed income, yes, but also real estate, commodities, maybe even alternatives depending on your situation.
What about geography?
Crucial. Geographic diversification means investing not just domestically, but in international markets too. This helps mitigate country-specific risks, like a local recession or political turmoil hitting just one nation.
And within equities, diversifying across sectors.
Yes, sector diversification is another layer. Holding a mix of, say, technology, healthcare, energy, consumer staples, it minimizes the hit if one particular sector goes through a downturn. For you as a retail income investor, using things like balanced mutual funds or a suite of diverse ETFs can be a practical way to achieve this broad diversification.
Okay, so diversification is key. How does MPT help us find the best diversified portfolio? This brings us to mean variance optimization, MVO.
Exactly. MVO and its visual representation, the efficient frontier. Markowitz formulated MVO as this precise optimization problem. Imagine, a vast universe of possible portfolios you could build from a set of assets.
An almost infinite number.
Right. MVO says that among all the portfolios that could achieve a specific return target, you should logically choose the one with the lowest variance, the lowest risk for that return level.
Any other portfolio giving the same return but with higher risk is inefficient.
It's inefficient. Why take on more risk if you don't have to for the same expected outcome?
Makes sense. And the efficient frontier is the graphical representation of all these efficient portfolios.
Precisely. Think of a graph risk, like standard deviation. on the horizontal axis, expected return on the vertical axis. The efficient frontier is this curve that sweeps upwards and to the right.
And what does that curve represent?
Every single point on that curve represents an optimal portfolio. It offers the absolute highest expected return you can get for that specific level of risk. Or, flip it around, the absolute lowest risk you can take for that specific level of expected return.
So if your portfolio isn't on that line,
It's suboptimal. You're either taking too much risk for the return you're getting, or you're leaving potential return on the table for the risk level you've chosen. Any portfolio below the frontier can be improved upon.
I know the original papers get quite mathematical here, talking about isomean curves and isovariance ellipses.
They do, and that was groundbreaking work mathematically. Those geometric concepts, parallel lines for equal mean returns, concentric ellipses for equal variance, were the tools Markowitz used to visually find that efficient frontier curve.
So for you listening, the key isn't necessarily the complex geometry, but the concept it represents.
Exactly. The concept is that there is an optimal set of portfolios, and MPT provides a framework to identify them. Those shapes were just the mathematical proof and visualization technique at the time.
So ultimately, MPT acts as a guide. It helps investors, helps you identify that specific point, that specific portfolio on the efficient frontier that aligns best with your personal risk tolerance and your financial goals.
Right. Are you conservative, primarily seeking stable income? You'd look at the lower risk end of the frontier. Are you more growth focused, willing to accept more volatility for potentially higher returns? You'd look further up the curve.
It provides a scientific, data-driven approach, helping to remove emotion, which can be so detrimental in investing.
Oh, hugely detrimental. MPT encourages a disciplined, systematic path, building a roadmap tailored for you, based on data and your preferences, not just on fear or greed or gut feelings.
Okay, that lays out the theory beautifully. But theory and practice can be different beasts. What about the real-world adoption and challenges?
Ah, yes. It's actually quite fascinating. Despite the sheer intellectual power of Markowitz's work, the practical adoption of quantitative risk return optimization by investment managers over the, 60 plus years since, it's been surprisingly slow.
Really? Why is that?
Well, its influence is undeniable, of course, but it's still primarily the domain of larger, more quantitatively focused firms. Many investment managers, even today, seem hesitant to use it in its, let's say, pure, out-of-the-box form.
And there must be reasons for that hesitation.
There are. Practitioners often find that directly applying textbook portfolio optimization can be unreliable in practice. They might see the output as opaque, hard to understand why it's recommending certain things, or unstable small changes in input data lead to wildly different portfolio suggestions, or simply unintuitive.
Like recommending a massive allocation to some obscure asset based on a tiny historical edge.
Exactly that kind of thing. And this perceived unreliability stems significantly from MPT's sensitivity to its inputs, particularly when the estimates for expected returns and risks are even slightly off, or when you layer on multiple interacting constraints in the optimization. Sometimes here, the error maximizer problem.
Error maximizer, explain that.
The idea is that estimation errors in your forecast's expected returns, how assets correlate, however small they seem, can get magnified by the optimization process, leading to significant impacts on the final portfolio weights.
So if you slightly overestimate a stock's return or underestimate its risk,
The optimizer might just load up on it, allocating a disproportionately high weight. Conversely, slightly underestimate returns or overestimate risk, and a perfectly good asset might get ignored entirely.
the bigger the error in the input, the bigger the distortion in the output portfolio.
Right, which can lead to these extreme, sometimes bizarre-looking allocations.
And I've read that sometimes simple, equally weighted portfolios, just dividing money evenly, have occasionally outperformed these complex MVO portfolios in the real world.
That has happened in some studies, yes. An MVO, left completely unconstrained, can produce these extreme weights that just don't feel right, like putting almost everything into one small cap stock.
So does this mean the theory itself is flawed?
Not necessarily. It doesn't signify a fundamental flaw in the core MPT concepts, I think. Rather, it really underscores the critical need for careful modifications, for enhancements to that classical framework.
To make it more reliable, stable, robust when dealing with real-world data and its inevitable imperfections and estimation errors.
Exactly. The theory is sound, but its application requires practical wisdom and adjustments.
We also need to look critically at some of MPT's underlying assumptions versus how markets actually behave, right?
Absolutely. A big one is market efficiency. Classical MPT often assumes a strong form efficient market. Everyone has perfect information, processes it instantly, and makes purely rational decisions.
Which sounds nice, but isn't quite reality.
Far from it, often. Markets are frequently imperfect. They're vulnerable to shocks, sudden economic downturns, abrupt policy changes, global pandemics, things that historical data couldn't predict.
These real-world disruptions really highlight the limits of assuming perfect efficiency and perfect rationality, don't they?
They really do. Consider something like the adaptive market hypothesis. It suggests markets don't always snap back to equilibrium quickly. And crucially, investors can be decidedly irrational, especially during stressful periods.
And market imperfections are real too. Things like different trading systems, dividend policies, some people just having better information than others.
Right, information asymmetry. All these things lead to divergent prices and actual returns. Real markets are just less efficient, less perfect than the idealized MPT assumptions sometimes suggest.
Then there's the assumption about investor behavior itself. MPT classically assumes investors are purely rational, logical, always risk-averse.
Which has been significantly challenged by the field of behavioral finance. This field brings psychology into economics and finance.
And what does behavioral finance tell us?
It reveals a much more complex human element. Our emotions, cognitive biases, psychological factors, they profoundly influence our investment decisions, often leading to outcomes that pure logic wouldn't predict.
Like the herd effect. Everyone piling into a hot stock or rushing for the exits together.
Exactly. That can drive prices far from fundamental value, disrupting that theoretical equilibrium. We also see variations in risk tolerance based on demographics, age, gender, background. Investor behavior isn't uniform or always rational.
So acknowledging this has led to extensions of MPT.
Yes, things like behavioral portfolio theory, or BPT, it tries to build a more comprehensive strategy by explicitly incorporating these emotional factors and, frankly, irrational behaviors into the framework.
Trying to get a better explanation for real-world market volatility and provide more robust guidance for you, the investor.
Precisely. It acknowledges people aren't just calculating machines.
Another critique often leveled at MPT is its reliance on historical data to estimate future risk and return.
Yes, and that's a big one, especially in today's world, which feels, increasingly uncertain. The core assumption that the future will look like the past carries significant risk.
Because major global events can happen that simply aren't in the historical data set.
Think about the COVID-19 pandemic. How much could purely historical data from before 2020 really prepare you for that kind of disruption? Not much.
Events like that can completely overturn market expectations, making historical averages seem almost irrelevant, at least for a time.
Right. And other inputs, like what constitutes a risk-free rate during a major crisis, might not accurately reflect current financial conditions either, potentially skewing the MP2 calculations.
All of which underscores the need for models that can better handle uncertainty and unexpected events, rather than just extrapolating from the past.
Exactly. We need more forward-looking elements, more adaptability.
There are also practical computational challenges, aren't there?
Yes, calculating the parameters MPT needs isn't always straightforward. The theory often assumes asset returns follow a neat, symmetrical bell curve, a normal distribution.
But real-world returns often don't look like that.
Frequently not. They often exhibit fat tails, meaning extreme events, big gains or big losses, happen more often than a normal distribution would predict. And because we estimate parameters like expected returns and correlations from historical data, there's always estimation error.
And other data issues can crop up, like stocks being suspended from trading.
That can distort the data, too, making accurate estimation harder. Plus, think about the sheer scale of modern markets.
Thousands of tradable assets, huge trading volumes.
Exactly. Investment risk is complex, driven by multiple factors, both systematic and non-systematic. It's often not captured well by simple linear relationships assumed in basic MPT applications. The scale and complexity demand more sophisticated tools.
So while maximizing returns seems simple in theory, applying MPT in the real world with all these constraints and complexities,
it becomes much more intricate. It highlights the need for effective mathematical models and powerful algorithms to bridge that gap between the theoretical ideal and practical, constrained reality.
Okay, that sets the stage for the challenges. Let's pivot now to the solutions and advancements. How has portfolio optimization evolved to tackle these issues?
A really critical advancement is directly incorporating transaction costs into the allocation process itself. This is huge.
Instead of treating them as an afterthought.
Exactly. Traditionally, you might optimize a portfolio, then hand it off to a trading desk to implement, and they'd worry about the costs. But that's suboptimal
Why?
because the target portfolio itself might be inherently expensive to trade into. Those costs eat directly into your realized risk-adjusted returns, the profit you actually keep after expenses.
So by integrating cost considerations before you finalize the target portfolio.
The resulting portfolios become much more cost-effective. You see improved performance because you're planning for the friction of trading from the start. For you as a retail income investor, lower costs mean more of your return stays in your pocket.
What kinds of costs are we talking about?
Broadly, two types. Direct costs, things like broker commissions, taxes, the bid-ask spread you pay when you buy or sell.
Okay, those are fairly obvious. What else?
Then there are indirect costs, primarily what's called slippage. This is the difference between the price you expected to trade at and the price you actually got.
Why does that happen?
It can happen due to random price movements while your order's being executed, but a big component is market impact cost.
Market impact. That's when my trade itself moves the price.
Precisely. If you're buying a large amount, you might push the price up against yourself. Selling a large amount can push it down. These costs can be substantial, especially if your trade is large relative to the asset's typical trading volume.
And researchers have developed ways to model this impact.
Yes, quite sophisticated models exist. For instance, the Almgren model from 2005 is well known. It explicitly estimates both permanent impact, a lasting shift in price, often linear with trade size, and temporary impact.
Temporary impact.
That's the short-term pressure on price while you're trading, often modeled as proportional to the square root of your trading rate relative to volume. So trading more slowly in a liquid stock incurs less temporary impact.
So the key takeaway for listeners is that professionals now actively model and account for these real frictions of trading.
That's right. Mathematically, adding market impact makes the MVO problem more complex. It becomes nonlinear. But the crucial point for you is that specialized computer programs, solvers, can handle this complexity.
Allowing the optimization to account for trading friction, leading to more practical, achievable, and ultimately more profitable portfolios. It's MPT adapted for the real, imperfect world.
Exactly. Another huge factor in practical application is constraints. Portfolio construction is almost never unconstrained in the real world.
Right. There are always rules or limits. Where do these come from?
All sorts of places, client guidelines certainly, regulatory restrictions, and even the portfolio manager's own discretionary views. For you as a retail investor using, say, a robo-advisor, constraints are likely built into their algorithms.
Can we categorize these constraints?
We can. You have regulatory constraints, things like the Investment Company Act of 1940 in the US or UCITS rules in Europe. These are hard limits, non-negotiable.
What about client-specific ones?
Those are guideline constraints. Maybe a client forbids investing in tobacco or weapons or limits the total number of stocks held. These are specified in the investment agreement?
Then managers might impose their own.
Yes. Discretionary exposure constraints. These often act as model insurance. The manager knows the model isn't perfect, so they might cap exposure to certain sectors or factors to prevent extreme bets based on potentially flawed inputs.
What about trading itself?
Trading constraints, like limiting how much of a stock's average daily volume you trade on any given day to manage that market impact we just discussed.
And finally, risk management.
Right. Risk management constraints. Limiting overall predicted portfolio volatility or capping the risk contribution from any single asset or group of assets helps enforce risk budgeting discipline.
It's interesting, all these constraints seem like they'd make the portfolio worse from a pure optimization standpoint.
Theoretically, yes. Adding a constraint can never improve the ex-ante-optimal solution found by the math. But practically, it's often the opposite.
How so?
Their inclusion frequently leads to better out-of-sample performance. That means the portfolio actually does better in the real world after it's implemented.
Because they prevent those extreme over-concentrated bets that might look good based on imperfect input data but blow up in reality.
Precisely. They act as essential guardrails, preventing the optimizer from going off the rails due to estimation errors.
And can we measure the impact of these constraints?
Yes, there are methods. One concept is the transfer coefficient. It measures the distortion the constraints cause between the theoretically ideal active weights and the actual constrained weights. A value of 1 means perfect alignment. Lower values show more distortion.
What about figuring out which constraint is causing the most trouble?
That's where shadow cost decomposition comes in. Using some advanced math, it assesses the costliness of each individual binding constraint, how much potential return you might be sacrificing, for example, by adhering to that specific limit.
That sounds incredibly useful for managers trying to balance rules with performance.
It is, and there's a subtle issue called misalignment that can arise from constraints. Even if your return forecasts, alpha, and your risk model are perfectly aligned, binding constraints can lead to the predicted active risk being significantly underestimated.
So the portfolio is riskier than the model says it is.
Effectively, yes. The constraints can mask hidden systematic risk factors. Methodologies like alpha alignment factors have been developed to address this by essentially penalizing exposures to these hidden factors during optimization.
Leading to portfolios with more accurate risk estimates that truly reflect the underlying exposures, even with constraints.
That's the goal. Which brings us to the broader issue of mitigating estimation errors in the MVO inputs themselves. This is absolutely crucial.
Okay, so how do we make the inputs better or make the model less sensitive to bad inputs?
Well, first, recognize that uncertainty from errors in expected returns usually has a much bigger impact on the final portfolio than errors in the covariance matrix, how assets move together.
So getting robust return estimates is priority number one.
Absolutely. Followed by variances, then correlations. Garbage in, garbage out is especially true here.
What are some practical ways to mitigate the impact of these errors?
One straightforward approach is simply imposing sensible constraints on portfolio weights. We touched on this, but things like setting a maximum percentage for any single stock or a common one. No short selling.
How does that help?
These simple limits act as practical safeguards. They prevent the optimizer from making wildly extreme bets even if the input data is slightly flawed. Interestingly, a no short selling constraint is mathematically equivalent to reducing the estimated correlations between assets, while upper bounds effectively increase them.
So constraints act as a kind of common sense check on the algorithm.
In a way, yes. Beyond just setting arbitrary upper or lower bounds, you can use diversification indicators as constraints.
How are those different?
They provide a more systematic way to limit concentration, often linking it to the perceived information content or confidence in the forecasts. The idea is if your portfolio is highly concentrated, it implies you have extremely high confidence in those specific bets. These indicators can force more diversification if confidence isn't warranted.
Okay, those are ways to constrain the output. What about improving the inputs themselves? You mentioned Bayesian techniques.
Yes, Bayesian methods, and particularly the Black-Litterman model, are widely used and very powerful for creating more robust MVO inputs. They leverage the statistical concept of the bias-variance trade-off.
Bias-variance trade-off.
Yeah.
What's the core idea?
The core idea is that by introducing a small, intentional amount of bias, maybe by leaning slightly towards a more common-sense market average view, you can significantly reduce the variance or instability of your estimates. This makes them more robust, less sensitive to noise in the data, less likely to produce extreme results.
And the Black-Litterman model is a specific way to do this.
Right. It's often called a market-based shrinkage approach. It calculates expected returns as a weighted average of two things.
What are two things?
First, the market equilibrium expected returns. Think of this as what the broad market consensus implies, maybe derived from a model like CAPM. Second, the investor's own specific views or subjective judgments about certain assets.
So it blends the market's view with your view. How does it weight them?
That's the clever part. The weights depend on the confidence the investor has in their own views versus the market equilibrium. If you have a very strong, confident view on a particular stock, the model gives your view more weight. If you're less sure, it leans more heavily on the market equilibrium view.
How does it work in practice? What are the steps?
There are essentially three key steps. First, the investor expresses their views, which assets they have views on, using a picking matrix, what their expected returns are for those assets, and crucially, how confident they are in each view, represented by a covariance matrix of the views.
Okay, define your views and confidence. Step 2.
Step 2 is estimating the market equilibrium. This usually involves using a model like CAPM to figure out the expected returns implied by the market across all assets.
And step 3.
Step 3 is calculating the final Black-Litterman expected returns. These are a confidence-weighted linear combination of the market equilibrium returns from step 2 and the investor's views from step 1. It's a structured way to blend market wisdom with your unique insights.
And you mentioned a particularly beneficial feature.
Yes, a crucial feature. When you input your view on, say, one or two stocks, the model doesn't just adjust the expected returns for those stocks. Because assets are correlated, it propagates the impact of your view across the expected returns of all assets in the portfolio.
So expressing a view on tech stock A might slightly change the implied return for energy stock B because of how they historically move together.
Exactly. And this helps prevent those corner solutions you sometimes get with simple or mean variance optimization,
Corner solutions.
where the optimizer sees a slight difference between your view and the market equilibrium as a massive arbitrage opportunity and wants to put almost everything into that one asset. Black Litterman smooths this out, nudging the solution towards a more balanced, diversified outcome even when you have strong convictions.
Very clever. What other approaches exist for dealing with input uncertainty?
Another powerful methodology is robust optimization. This directly tackles the sensitivity issue head-on.
How does it work?
Instead of using single-point estimates for inputs like expected returns, it defines uncertainty sets around them. It assumes each input parameter could fall anywhere within a plausible range.
Okay, so it acknowledges the inputs aren't perfectly known. Then what?
Then it adopts an adversarial perspective. It essentially assumes the worst-case realization of those input parameters within their uncertainty sets will occur. It's like stress testing your portfolio against the most unfavorable combination of possibilities within that defined range.
So the goal is to build a portfolio that performs reasonably well, even if things turn out slightly worse than expected.
Precisely. The objective becomes choosing a portfolio that maximizes your outcome, or utility, under this pessimistic worst-case scenario within the uncertainty set. It builds in resilience.
That sounds computationally intensive.
It used to be, but modern optimization techniques, things like second-order cone programming, semi-definite programming, have made these complex, robust formulations computationally tractable, even for large portfolios.
So it's practical now to design portfolios that are inherently more resilient to estimation errors and unexpected market shifts, offering a greater margin of safety for you as an investor.
Exactly. It's a significant step forward.
Another area of advancement is looking beyond just mean and variance, right? Incorporating higher moments.
Yes, that's vital. The classical mean variance framework has limitations because it implicitly assumes either a specific type of investor preference, quadratic utility, or, more commonly, that asset returns follow a perfect joint normal distribution, that neat bell curve.
And we know real-world returns often don't fit that bell curve perfectly.
Right. They often exhibit fat tails, more extreme events than predicted, and asymmetry or skewness returns aren't symmetrically distributed around the average. Maybe downside moves are sharper or more frequent than upside ones.
And these higher moments, skewness and kurtosis, which measures the fatness of the tails, they can significantly affect your actual portfolio performance.
Absolutely. If a strategy generates positive average returns but has significant negative skew, it means you might get frequent small gains punctuated by occasional large losses. That might not suit an income investor.
So just looking at average return and volatility isn't enough. You need to understand the shape of the potential outcomes.
Precisely. So alternatives have been developed. One approach extends the mean variance framework by directly incorporating estimates of portfolio skewness and kurtosis, perhaps using mathematical approximations like a Taylor series expansion.
What about focusing specifically on the downside risk?
That's another important direction. Instead of just using standard deviation, variance, as the risk measure, optimization can maximize expected return subject to constraints on tail risk measures.
Like value at risk, VR.
VAR is a common one. It estimates the maximum loss you might expect over a period with a certain confidence level. Like, there's a 95% chance my portfolio won't lose more than X dollars tomorrow.
But VAR has limitations, doesn't it? It doesn't say how much you could lose in that worst 5% scenario.
Correct. That's where conditional value at risk, or CVR, comes in. It's often considered mathematically superior. CVR measures the expected loss given that you are already in that bad tail event defined by VAR.
So it answers the question, if things go bad beyond the VAR level, how bad is it likely to get on average?
Exactly. And the good news is that optimizing portfolios using CVR constraints can often be formulated as efficient linear programs, making it a very practical and powerful tool for managing those potentially damaging extreme downside risks.
Okay, fascinating advancements. Now, let's look ahead. What are some of the newer directions and future trends shaping portfolio optimization?
Well, one area is the continued evolution of diversification methods. We talked about moving beyond simple, equally weighted portfolios.
Even though Those have sometimes performed surprisingly well, likely because they don't rely on potentially flawed return forecasts.
Right, their simplicity can be a strength. But more sophisticated approaches aim to be smarter about diversification. This includes risk-based allocation approaches.
These use a risk model but deliberately ignore return forecasts.
Exactly. The philosophy is, forecasting returns is hard and error-prone, so let's focus on managing risk, which we might be able to estimate more reliably. A classic example is the global minimum variance portfolio, simply aiming for the lowest possible overall volatility.
And you also mentioned risk parity earlier. How does that fit in?
Risk parity is a very popular risk-based approach. The goal isn't equal capital allocation, but equal risk allocation. You want each asset or strategy in your portfolio to contribute equally to the total portfolio risk.
So a riskier asset would get a smaller capital allocation than a less risky asset to achieve that balance.
Generally, yes. It's based on estimates of future variance and covariance. The aim is true diversification of risk sources.
To implement that, you need a way to measure how much risk each asset contributes.
Absolutely. Precise measurement of risk contributions is essential. A common and intuitive definition calculates it as the asset's weight multiplied by its marginal risk contribution, how much portfolio risk changes for a tiny change in that asset's weight.
And the neat thing is, if you sum up these risk contributions for all assets,
They add up exactly to the total portfolio risk. This gives you a clear breakdown, a budget showing exactly where your portfolio's risk is coming from, invaluable for you as an investor to understand your exposures.
how are risk parity portfolios actually built? Is it complex?
It involves solving an optimization problem, typically minimizing the deviation from equal risk contributions. While it can be mathematically tricky in general, non-convex, for long-only portfolios, which is relevant for most retail investors, there are formulations like using a logarithmic penalty that guarantee a unique optimal solution.
So it's a robust way to build portfolios where risk is genuinely balanced across the components.
Yes, very much aligned with the core diversification philosophy.
Another challenging area you mentioned is mixing different types of forecasts, or alphas.
Right. What happens when your investment views come from different sources or operate on different timescales? This is common in institutional settings, but the principles apply.
Like combining a long-term strategic view on, say, emerging markets with a short-term tactical view on a specific stock.
Exactly. How do you blend those effectively in one portfolio? It might require using separate decision variables for assets influenced by different views.
Why?
It allows you to, for instance, constrain the risk coming specifically from the tactical bets, or track the performance attributions separately. Did the strategic view or the tactical view add value? Or even treat trades differently based on their expected holding period.
What about views on groups versus individual stocks? Like being bullish on a specific company but bearish on its home country.
That's another complex scenario. You might use tools like an incidence matrix to map securities to groups, like countries or sectors. Then, a scaled benchmark approach can help separate the value added by the group-level view versus the stock-specific view.
But managing these different holding periods and forecast types is still an active research area.
Very much so. Properly handling these different time horizons often leads you into the realm of multi-period portfolio optimization.
Thinking beyond just the next rebalancing period.
Exactly. Multi-period models offer significant theoretical advantages over single-period MVO. They can capture important intertemporal effects,
Like what?
like hedging demands. Maybe holding a certain asset today helps hedge against future risks, or considering return predictability if you think an asset's return might mean revert. That affects your optimal holding over time. And crucially, the lasting impact of today's trades on future prices, that market impact again.
This relates to optimal execution strategies.
Yes, optimal execution explicitly models and optimizes that trade-off. Trade quickly and incur higher market impact costs, or trade slowly over time to reduce impact but expose yourself to price volatility while you wait. Portfolio managers often break large orders into smaller pieces precisely to manage this.
So a multi-period framework ties all this together: risk, return predictability, like alpha decay, how quickly an edge fades, market impact costs over time.
That's the idea. It's often formulated as a complex stochastic control problem. The output isn't just a static target portfolio, but a dynamic strategy that adapts based on evolving conditions and the ongoing friction of trading costs.
Sounds powerful. Why isn't it used everywhere?
Practical challenges have limited its widespread adoption, especially beyond large institutions. It's incredibly difficult to accurately estimate returns and risks for multiple future periods. The computational burden for large asset universes is immense, and handling real-world constraints across multiple time periods adds layers of complexity.
So in practice, many still rely on sequences of single-period optimization, rebalancing periodically.
Often, yes, it's a pragmatic compromise, but the multi-period framework provides valuable theoretical insights.
Finally, how does all this connect to the digital age? Technology must be playing a role.
Oh, absolutely. Advanced algorithms, artificial intelligence, machine learning, these techniques are now being employed to enhance virtually every aspect of this process. Portfolio optimization, risk assessment, market forecasting.
Bringing the theoretical rigor of MPT closer to practical, accessible implementation.
Exactly. Technology is bridging that gap.
And for you, our retail income investors, what does this mean?
It means these powerful tools are becoming increasingly accessible. They can help you maintain properly balanced, diversified portfolios. Think about robo-advisors automatically rebalancing for you, or performing tax loss harvesting, selling losers strategically to offset gains elsewhere.
So technology is democratizing access to sophisticated portfolio management strategies that were once only available to the very wealthy.
That's a great way to put it. It puts these powerful MPT-derived strategies, enhanced by modern tech, directly into your hands, helping you manage your investments more effectively and efficiently.
Well, this has been a truly comprehensive journey through modern portfolio theory. I hope this deep dive has given you a solid understanding of its foundations, its challenges, and its continuing evolution.
Its profound and ongoing impact really is foundational for navigating financial markets. Markowitz truly set the stage.
And while classical MPT, as we've discussed, has limitations,
The continuous research, the advancements in computation, the integration of behavioral insights, all this ensures MPT remains relevant and adaptable. It keeps evolving to tackle the complexities of today's investment world.
so as a final provocative thought for you, our discerning retail income investor, consider this. Despite the ever-increasing sophistication of these portfolio optimization models, true investment mastery likely remains a blend. It's part quantitative skill, yes, but also requires a deep understanding of market dynamics.
It requires not just access to the models, but the wisdom to interpret their outputs, understand their inherent limitations, and apply them with disciplined foresight. Your critical thinking is still your most valuable asset.
Couldn't agree more.
This deep dive was brought to you by Finbot Insights.
And please remember to click like and subscribe to the Finbot Insights channel. We'll have more in-depth explorations of critical financial concepts designed to empower your investment journey.
Thanks for listening.